So I've had another day to sit and stew on the reality of the new bailout regime that was unveiled by the Fed and the Treasury on Sunday. And I think the implications are pretty remarkable. It would seem as though the Fed, within reason, has made it impossible for banks to go bankrupt, which is, it's hard to call that reasonable. It sounds mathematically impossible. How is it impossible to go bankrupt? Well, this new facility, which is what the Fed always calls whatever their new corporate welfare program is for the banks, they plan to lend against whatever assets the bank has at par. And so I believe this is in addition to guaranteeing the deposits of SVB and Signature. I believe they just outright did that. They just said, you know what, no matter what, we're just going to get money to you depositors directly. But here, moving forward, any bank who wants to can borrow against their assets at par value. So what that means is that there's no longer any risk associated with owning securities if you're a bank. This is important because, as I and so many other people discussed, banks are in the business of managing interest rate risk. If the bank makes loans, let's say at 3%, as so many banks did, let's say they make some 3% mortgages, and that's what they have on their balance sheet, are a bunch of 30-year mortgages paying 3%, and then mortgage rates go up to 7%, as they have now, and all of a sudden savers expect to get more for their deposits than the measly, 0.25% or 0.5%, whatever the banks were paying annually in savings or checking accounts. The banks are unable to pay more to their depositors because all they've got on their balance sheet are these low-yielding 3% mortgages. Or in the case of a Silicon Valley Bank, they were mortgage-backed securities and treasuries. And I don't want to go through boring people with explaining the way that bond prices work, but basically those assets are not worth what they paid for them. They're underwater. Their assets are worth less than what they cost the bank to purchase them. And so when depositors, and remember, banks pay for these assets with deposits, when depositors say, hey, you know what, I want to get a higher yield on my savings, I'm just going to go out and buy treasuries, because a treasury bond now, or at this point, maybe not today, I don't know, but at whatever this time was, past couple months, treasuries were paying more than a savings account at Silicon Valley Bank. And so people start pulling out their savings, and Silicon Valley Bank has to sell those assets at a loss in order to meet the demand for withdrawals. And that's how they went bankrupt. They had to sell all their assets at a loss, and when your assets are less than your liabilities, you're bankrupt. So what the Fed is doing is saying now essentially that they will guarantee the value of any asset as long as it is a treasury, a mortgage-backed security, or any sort of agency debt. So any federal debt or a mortgage-backed security, which of course is packaged by federal agencies, Fannie and Freddie. That's why mortgage-backed securities are kind of treated like treasuries. It's because the federal government is who makes mortgage-backed securities. And so this is a bailout facility for banks who don't actually have mortgages or loans to their customers on their balance sheet. This is incentivizing banks not to lend out money, but just to take all their depositors' money and go buy treasuries or go buy mortgage-backed securities or just anything like that, because those are guaranteed safe now. And by safe, I don't just mean, oh, well, if you hold to maturity, you'll get your money back. No, they were already safe in that sense because the federal government can't go bankrupt because the Fed will just bail them out. Everyone knows that. No, they're safe from interest rate risk. So they guarantee the price at any given time. There is no more price risk if you're a bank and you hold treasuries or mortgage-backed securities. Honestly, my instinct right now is to go out and start a bank, because you can't lose. Now, I don't have the money to start a bank. I'm not some rich guy. But if I was, who knows? Maybe I can look at, maybe there's some way you can start a bank. I don't know. Maybe you can get a loan from another bank to start a bank. I probably can. Or maybe I could find some investors. But you can't lose. Because let me tell you, if you get into a situation like Silicon Valley Bank was in, to where you have people wanting to pull their money out because you're not paying enough interest to the depositors, and so the depositors say, "Well, I want my money out. I'm going to put my money somewhere where I can earn more interest," and you don't have the money right now because your low-yielding securities that you own, your 10-year Treasury paying 1.75%. Is the value that's in the toilet, because treasuries are, 10-year Treasury is yielding like, I don't know, 3.75% or something. I haven't looked at the numbers in a while, so I'm just throwing things out there. Those are not realistic, or those are not accurate, so don't quote me on that. But anyway, you can then just go to the Fed and borrow against the value of that Treasury at par value. Not necessarily what you paid. If you paid over par, well, then you're screwed, or not entirely screwed, but, you're still better off, but you won't be 100% made whole. But you can borrow against the par value. So as long as you buy at or below par, any of these treasuries, the Fed will back you up and give you the money. Now, they won't buy them from you at par, but they will loan you money at par, and so you just have to make the interest. And the Fed is I'm sure, going to lend at very favorable rates. So what this does is this further incentivizes banks not to lend people money. Banks already were somewhat disincentivized from lending money because of interest on excess reserves, which after the abolition of reserve requirements just became interest on reserves. Now the banks have essentially another largely riskless way of collecting interest. So I don't want to act like the Fed's a bunch of geniuses. I mean, all they do is they see banksters who are running out of money, and they say, "Here, we'll bail you out." That doesn't take a genius to just plug whatever holes there are in the banking system every time they make themselves known. But it's hard for me to see that there's going to be a bunch of bank collapses now that I've really looked into what they did. Unless you've got banks that are that actually hold real mortgages and real loans on their balance sheet, like a true community bank that takes depositors' money and actually lends it back in that same community. In that case, I don't think that they would be protected by this at all. But seeing this, they would be stupid not to get into this business. They should do what they can to try and get those loans off of their balance sheets, get them securitized by Fannie and Freddie, and fill their balance sheet with things that the Fed is willing to back. So this might be the end of the 2023 financial crisis. It might be over before it even got started. So here's to hoping that the Fed is so confident in what they've done that they will go ahead and hike rates anyway, even though all the Wall Street folks are begging for a rate cut now. What's the point in cutting rates if there's no more interest rate risk? That was the whole issue with the Fed raising rates, is that created a big risk for all the banks that owned all this low-yielding debt. Well, now the Fed is saying, don't worry, we got your back. They've abolished interest rate risk. There's no rules. You can't lose. It's all upside if you're a bank. So, with that said, I will see you folks back here tomorrow.